Hi, guys. It is January 4th at right around 8 o'clock in the morning, my time. That would be 10 o'clock Eastern time. The news that I wanted to start off going over today, first and foremost, Fed's balance sheet. Total assets are up to 7.3 trillion. We have a chart of the Fed's balance sheet, and it went parabolic in March, but then it's gradually continued to go up after a little bit of a dip in, looks like July. Then we just kept going up and up and up and up. I personally think the Fed's balance sheet will be over 10 trillion by the end of 2021. I don't think that's a stretch, but we shall see. And of course, this is translating, and you'll notice the Fed's balance sheet doesn't always have to do this because we know they're printing bank reserves. They're not really directly injecting money into the real economy, but now we can see that the broad money, or M2, some of the deposits in the commercial banking system, and we have to realize that there are a lot of activity in the form of dollars going on in the shadows with the Eurodollar market. But from just the Fed's numbers, if we want to take them at face value, we can see that now the base money that's being created is translating almost directly into additional M2 money supply, broad money. In other words, currency units that are in the real economy chasing goods and services. A lot of people look at this from a demand side. I think you've also got to look at it from a supply side, meaning that with lockdowns going into a second wave, or whatever you want to call what we're dealing with right now, with the cerveza sickness, regardless of your opinion on it, the bottom line is it reduces supply of goods and services. So we've got an increased amount of currency units potentially hitting the commercial banking system in the form of deposits, and we have supply chains being destroyed, and a lot of the supply, or just the stuff that we can buy, decreasing in amounts. Therefore, you'd most likely expect prices for consumer goods to increase. A lot of smart people are smarter than I would say that's temporary. We shall see. I think with what's going on with stimulus, it's going to be a little bit more permanent. All right, the next article, actually, I wanted to go over the dollar as well because I thought that was important. I looked at my phone this morning, and the dollar was down to 89.67, which is the lowest point I've actually, in today's range, I'm looking at my phone, it dropped down to 89.42. So I'm by no means a technician, but I'd be curious to see if that took out some sort of moving average or some sort of technical level. But it seems to be going down now. I think it's oversold. I totally understand what my buddy Brent Johnson is saying, and he had some amazing charts. I'd suggest checking him out if you get a chance, or check out that last interview I did with him. But it looks like the dollar is still substantially down, and we'll see where it goes from here. Main article I wanted to point out was just a couple days old, actually, but I wanted to make a point here. New stimulus package makes it easier to qualify for food stamps. Here's what you need to know. And also check out the related articles. $600 stimulus checks are officially on the way. Your second $600 stimulus check could be delayed. Then stimulus package boosts food stamps by 15%. In college, you could be eligible for $1,800 in stimulus checks. And I know that these are related topics, but my point is, I think we need to understand the economy right now is almost entirely being propped up by stimulus. And I sent out a tweet the other day. Actually, we might be able to go over to it here. That would be kind of cool. Let's see if I can go to see if I can figure out how to do this. I just figured out how to put Twitter on my desktop just to do these videos. So maybe if I go to the top there, hopefully, yeah, okay, cool. I can go here. So let me see if I can find this tweet. Well, the bottom line is the tweet was talking about how the economy is propped up, as we know, by asset prices. And asset prices, I think, because we've gone from here we go. We've gone from a Fed put to a government put. And therefore, you could argue that asset prices are being propped up now by stimulus. So if you take that stimulus away, the economy crashes. And the reason this is important is because we need to get our minds around the fact that currency units or stimulus checks do not make us rich. As a matter of fact, it makes us poorer over the long run because it is misallocating resources and creating an epic amount of malinvestment. And in my live stream yesterday, I used the example, back in the day, Mises argued that even fractional reserve banking, even free banking, where the government was not involved, created a minor boom bust cycle. If just free banking creates a slight boom bust cycle and a misallocation of resources, what on earth does $3 trillion in stimulus do? I mean, or a $5 trillion deficit in just 1 year. So my point of this article and my point with this tweet is to say that, or to point out that the United States is building its entire economy around stimulus. And I don't understand how more people aren't concerned with this. Let's look at Venezuela. Most people would acknowledge that Venezuela's big problem was they built their entire economy around oil. Not good. Or when I was in Ecuador, as an example, they subsidized the cost of fuel, of gas and diesel, to where even when I was there, let's say 3 or 4 years ago, you could get a gallon of gas for like, I can't remember what it was, like 75 cents or something like that, like literally. So it was maybe even less than that. I can't recall. But so my point is they're building their entire economy around this subsidy. So you can never take the subsidy away, never, because you're building all of this infrastructure. You're building all of these businesses. You're building all of these systems around fuel being 50 cents a gallon. Or in the case of Venezuela, you're building the entire economy around the fact that oil prices are $100 a barrel. So what happens when oil prices go down? The economy collapses. What happens in Ecuador if you just used a market price for fuel? The economy would, I don't know if it would collapse, but it would struggle. I mean, you would go into a deep, deep recession. And we are doing the same thing with our economy right now. We're just building the whole thing around stimulus. So what happens when you take the stimulus away? It'll be the exact same thing as when oil crashes in Venezuela. Maybe not to that extent. I'm not saying we're going to get hyperinflation here, but it's going to create massive economic pain. And we need to understand this. So not only from an economic standpoint, but we have to figure it out to set up our portfolio. And you say, well, George, how do I do that? Okay, well, we understand that if they take stimulus away, if they take the punch bowl away, whatever you want to call it, that the economy is going to go into crisis mode. We know the pain tolerance for politicians and the average American right now is right around 0. So they're most likely, and there are no certainties, only probabilities, but the probability is high that they're going to continue stimulus regardless. So if they continue stimulus, that means they continue the deficit spending. If they continue the deficit spending, most likely that means the Fed continues to monetize the debt and their balance sheet continues to go up and to the right. It might go parabolic again. And if what we've seen in 2020 is the Fed's balance sheet directly affecting M2 money supply, then we come to the conclusion that in the future, and I'm not saying it happens overnight or in a year, I'm saying 5 years down the road, we're going to see gradually more currency units chasing a fewer amount of goods and services. So potentially the dollar going down even further. All right, we'll make it a wrap. That's the first video for January 4th. We'll be back here in maybe an hour or two, or whenever I find the next interesting topic that I'd like to go over. We'll see you guys in a bit.